Meta Platforms, ticker symbol META, reported earnings after the bell, a blockbuster earnings report with the stock gapping up nearly 12% after the earnings call, and absolutely fantastic, trading at $775. I own this in my portfolio. My average cost basis is about $112 per share. This has been an absolute big winner for me, and we are going to talk about Meta and what it means for the AI trade. But guys, before we dive in, if you could please go ahead, like and subscribe. It really helps me out. Let's dive into it. Now, Meta, formerly known as Facebook, is a technology company that develops and manages social media platforms, communication services, and virtual reality technology. Their core business revolves around connecting people, building communities, and enabling businesses to grow, and monetizes that through running ads on their platforms, their family of apps. And the quarter was incredible, a massive beat across the board. Revenue grew 22%. The expectation was for 16% growth for the quarter. $47 billion revenue reported. AI is really seeing the revenue inflect in recent quarters. The estimate was for 44.8 billion. Insane. And you can see it right here. 587 versus $7.14 in earnings per share, growing 38% year over year. Gross margins inflected to the upside. Net income inflected to the upside. Free cash flow margins did not. However, this is due to the large amount of CapEx they expend. We'll talk about it, but the company's still doing $9 billion in free cash flow every single quarter, right? That's just money they spit out that they don't have any use for. It's just free cash flow. It's even after capital expenditures. So $9 billion net income year for the company, $18 billion, growing from the $13.4 billion mark. And despite the heavy capital expenditures they're going through, the company's balance sheet still remains largely robust with $47 billion in cash, $49 billion in debt. Very solid. Margins expanding, gross margins expanding, extremely solid stuff. And the balance sheet is not a worry at all, simply because when cash is paying you 4% and you can get debt that's anywhere from 4 to 6% in interest, right? And when you have a company that reports return on equity of 40%, return on assets of 18%, return on invested capital of 22%, you want to take on as much debt and spend as much money as humanly possible, because you know your return in the long run is going to be well worth it. And that's exactly what Meta is doing, and they're starting to see the fruits of their labor. You can see a revenue up 22% from 39 billion from the same quarter last year in 2024 to 47 billion right here. Cost and expenses was only up 12% in the same period, and that is how we get net income up 36% on the year. And you could see operating margins right here inflected from 38% to 43%. Just an all-round good call. And this is even with the disaster that is Reality Labs. You can see this segment right here, Reality Labs, or their virtual reality segment, growing from 353 million, a very small segment, to 370 million. And at the same time, the company actually are losing money. You can see income/loss from operations of $4.5 billion. So Meta right here taking a $16 billion yearly loss and still spitting out, between $9 and $14 billion in free cash flow. Really goes to show how profitable this company is. If Zuckerberg was just to remove this segment, say, we're done with Reality Labs, that's an automatic $4 billion in free cash flow every single quarter that'll go to shareholders that can go in the form of a dividend, a buyback, capital expenditures. You can buy Bitcoin with that money. I don't know. But Zuckerberg is really intent on this Reality Labs division, and this is the one thing I would say that really hurts the quarter every single earnings. It's simply just this Reality Labs division. It's literally a cash burn. And I mean, they've spent, I think it's like $50 billion on Reality Labs to only see $370 million for the quarter. I don't know if that is a strong return on investment. But looking at some of the other highlights for the quarter, family daily active people, what Facebook calls DAPs, was 3.48 billion. There's like 7 billion, 8 billion people in the world, right? That's an increase of 6% year over year. Ad impressions, so in other words, the amount of ads shown on their platforms, increased 11% year over year. Where is Zuck finding these people? This is crazy. He's probably just showing more ads, more relevant ads for people thanks to AI. I'm guessing that is what's happening there. So when you have more people using your platform and you're showing more impressions, right, with your average price per ad increasing 9% year over year, that is how you get the 36% in earnings per share growth, 22% in revenue growth, including a division that's burning $4 billion every single quarter in Reality Labs. Meta's headcount increased 7%, and it's very, very clear if you look at these metrics right here, that this is really paying off because these numbers are increasing faster than the headcount is actually increasing. That's incredibly solid stuff. Meta is hiring the right people and they're scaling very effectively, almost too efficiently, you would say, but that's not a thing. Looking at capital expenditures for the quarter, it trailed at $52 billion. That's up 82% from a year ago. And this is $52 billion in capital expenditure over the last 12 months. Remember that figure, $52 billion. Now, looking at guidance, Meta actually lifted their guidance. This is why the stock was up in a very big way. When you look at revenue guide, the street was expecting a $46.2 billion number at the midpoint. Zuck and his team came out and said, we're looking for 47 to 50.5 billion. The midpoint is not even at the low end of the range. Zuck's team beat the midpoint estimate by $1 billion or $800 million. And this, I think, is why the stock was up so much. The street are starting to see the benefit of all of the capital expenditures that Zuck and his team put into Meta into 23, into 2024, and the fruits of their labor is coming to fruition. At the same time, AI is also creating efficiencies. Look at this, full year 2025 total expenses in the range of 114 to 117 billion, which narrowed from 113 to 118 billion. So efficiency gains are currently being seen in the year end now. So you got an increase in revenue, right? Decrease in expenses potentially. That's how you get that operating leverage and margins expanding, which we saw this quarter. And then currently, capital expenditures for the full year expected to be 66 to 72 billion dollars. The last 12 months, capital expenditures were 52 billion. So you're seeing an increase in capital expenditures overall. So the company is still spending to generate this type of top line and this type of margins. Very, very solid stuff here from Zuckerberg. And that is ultimately the Meta thesis. He said it at the very top of the earnings call right here. Mark Zuckerberg said, I am excited to build personal super intelligence for everybody in the world. Zuckerberg has the scale. And if he goes ahead and does that, Meta is going to be the go-to platform for AI. And if you're buying Meta today, this is what you're betting on. Now let's actually look at the financials and the outlook for the company. Now, still a cheap stock in my opinion. We've seen a big move here in the multiple for Meta. However, it still trades at 14 times EV to EBITDA. That's not crazy. That's not crazy at all. 25 times PE, that's above a market multiple. But again, still not crazy if you ask me, and a 2.5% shareholder yield. And this is how I value the company, right? And I still think Meta is fairly valued in my opinion. I think this is still a great place to buy even after the 10% gap up. So if you look at the trailing 12-month revenues and use 13% growth over the next 5 years, opinion I think is conservative. And then you see net margins going from 38 to 42. Again, I think that's a conservative figure, but that's what we're using. You're looking at $138 billion in net income, 2029. Using a 22 PE, which is actually a contraction, right? I'm just using the market multiple for the S&P 500. Get the enterprise value, subtract the net debt, divide by shares outstanding. I'm assuming shares outstanding are going to decrease by 1% every single year. You get the stock price of $1,473. In 2029, the current stock price of $774 with a 0.33% dividend yield. You're looking at about a 14% CAGR over the next 5 years. And this is probably a better buy than the S&P 500. You can see the fair value for Meta, 732. And even though that does look steep, it's far better to buy a high quality company at a fair value than like a crappy company at a cheap value. And Meta is one of the best companies out there in the year and now, and the leader in AI. They're just showing it. Revenues and margins are starting to inflect. I think this is going to continue. I continue to hold Meta. I might just add more after these earnings. This was absolutely fantastic. The stock still looks cheap. 14% CAGR over the next 5 years. I think that'll beat the S&P 500. The average analyst price target is about $734, but I think we're going to see a massive raise for all of them as time goes on. I wouldn't be surprised to see $1,000 end of year price targets for Meta. Looking at the technical charts, I think Meta's going to gap up to around about this level. If we do see some form of a pullback, right, let's say in August or September, back to these levels right here, that would be the opportunity to buy and get long, looking for the $1,000 level for Meta. Ultimately, this is where you want to buy Meta. If we can get back to the 720, 730 zone, that's the place where you want to go ahead, buy Meta for the long term, buy and hold. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.